Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Charles Hugh Smith. He's author, leading global finance blogger, and America's philosopher, we call him. He's the author of several books on our economy and society, including A Radically Beneficial World, Automation, Technology, and Creating Jobs for All, Resistance, Revolution, Liberation, A Model for Positive Change, The Nearly Free University in the Emerging Economy, Pathfinding Our Destiny, one of his latest books, Preventing the Final Fall of Our Democratic Republic, and most recently, Will You Be Richer or Poorer? His blog of twominds.com is one of CNBC's top alternative finance sites. Welcome, Charles.
Thank you, Richard. It's always a pleasure.
Great. So the topic today we'd like to discuss is actually bringing together a number of trends that are happening between the coronavirus, emerging financial crisis globally, perhaps coming out of Europe, and what's happening to the economy due to shutdowns around the world, especially in the Western world as the coronavirus spreads. Your initial thoughts?
Yeah, actually, Richard, we were talking before we started recording about the issue of whether the lockdowns and other sort of official responses in the West, whether they're really that effective, or are they an overreaction? And so you had some statistics just to give us some context, and I thought that was a good place to start.
Yeah, let's take a look at those statistics. I mean, there's the question of, is this really a pandemic? Is it perhaps hysteria on what's happening? Because if you look at the annual numbers of deaths worldwide due to the flu-like diseases, those are in the range, according to WHO, World Health Organization, of 210,000 to 600,000 people worldwide dying of these flu-like diseases. And generally 14% of those are coronavirus. So the coronavirus, there's several types of it. Right now there's 7 or 8 types. Before this year, there were 6 or 7. So there's like one new one this year that is the COVID-19 one. But the 14%, if you look at that, that would translate to 30,000 to 84,000 deaths worldwide in the year, in the flu season. And so now we're up to 40,000 number in terms of deaths. So by that measure, we're in the same yearly process number. It looks like a fairly normal year in between that range, 30,000 to 84,000. So even if it doubles at this point, it's still in the normal range. Now, it could go over as well. But for now, if you even look at the numbers in the U.S., 23,000 U.S. deaths due to the flu, 3,000 from coronavirus. So that's a factor of 8. So it's like 8 times as many deaths due to the flu. So where's the pandemic? I mean, we don't shut the economy down every year due to the flu. So why is this happening for the coronavirus? Has it been hyped up by the media and the medical establishment? Your thoughts?
Yeah, it's a good question, and of course, if we put ourselves in the position of the authorities, we can understand their maybe initial propensity to overreact because they didn't know enough about this disease, right? And but now that we've had a couple of months of data, then it's really starting to become clear that there's other models that other than lockdown that seem to be equally effective. And again, before that we started recording, we were discussing the well-known models of South Korea and Singapore, but more recently, Sweden's approach. So maybe you could talk a little bit about that.
Yeah, at one end of the spectrum, we have Sweden that has taken essentially doing nothing. But I mean, by that, what they've been doing is just encouraging people at the personal level. If you have the flu, or take a responsible move and quarantine yourself, or uh, stay away from people. Sort of more at the personal level. So it's been some general ideas and suggestions to the population, and they're not doing too bad. I mean, there's only 105 deaths from the numbers that we see so far in Sweden due to the coronavirus. In South Korea and Singapore, we can also look at that. They've been doing a much more structured approach. And while people might point to Singapore as being small and more manageable, South Korea has a large population, relatively large, 51 million people. So it's about 50% higher population than Canada, for example. And within South Korea, it's only been 139 deaths, numbers that we've seen, and 9,300 cases or so. And the theme in both of these countries, South Korea and Singapore, has been no shutdown of the economy. Let's continue. Everything is open, restaurants, businesses. But what is happening there is the process they're taking is essentially around 3 points. They are doing widespread testing, so that's a key factor. And then they're isolating cases and doing a tracking process of where there's an actual case to where that person has been, where they're going, other people in contact. And then if there are suspected cases, they're quarantining those suspected cases. So those are the three process steps they're doing: widespread testing, isolating cases, and quarantining suspected cases. And they've had some good success. So is it necessary to shut down the entire economy and risk an economic depression, which is what's happening in many jurisdictions in the Western world? For example, here in Ontario, where I am, and I believe also in the U.S., and where you are, Hawaii, if you wanted to elaborate a bit more on that.
Yeah, it's here in Hawaii, which of course is very heavily dependent on tourism. It's basically shut down the entire tourism industry. And so that seems to be an extreme policy. And as you mentioned, Richard, the question, then it opens the question, are the financial and economic consequences, are they recoverable in a limited amount of time? In other words, is the damage really severe? And so, the other issue, which again we spoke about briefly before we started recording, which is what are the consequences of like the sort of power grab of central authority that we're seeing, where there's sort of a grab bag of centralization extending its powers. And if it was just about social distancing, I mean, we could say, okay, that's going to be a temporary measure. But then there's all these other things that are being proposed or enacted in terms of limiting freedom of movement and financial, responses. So maybe you could speak to that. These sort of centralized authority overreactions that may not be temporary.
Yeah, and even exploring more as to the causes of that. I mean, is there something else going on here? No conspiracy theory, but why is this being hyped up? It appears to relative to other things like the flu or car accidents that are much higher, 8 times higher, 10 times higher than what the coronavirus is giving in terms of deaths. So perhaps we can begin with a discussion with one of our previous sessions. We talked about the repo crisis or repurchase agreement market and the related US dollar funding shortage that was started about the September timeframe of late last year, and in the last 3 or 4 weeks has gotten to really be out of control by central banks. The situation, for example, by the Federal Reserve, they have had to pump in extensive amount of liquidity, 50 billion, 100 billion, 150 billion weekly basis, in order to maintain the liquidity in this repo market, which is very critical to the financial system. A lot of people haven't heard of this, but it does affect the short end of the yield curve. A lot of the interest rates, we talked about this at the short end, have been rising higher due to credit risks in the economy. And the Fed has stepped in to try to prevent that to try to prevent interest rates from rising. And it appears that they've lost control. They haven't been able to get control. And this was actually happening at the same time as the COVID run-up. So nothing conspiratorial here, but the idea of authorities using the COVID hysteria as an opportunity, never let a crisis go to waste, in order to seize control, to do a power grab here, is definitely here. Your thoughts?
Yeah, Richard, I liked your terminology that you used before we started recording, the Keynesian end point. In other words, the idea that central banks can just create money out of thin air and pump it into the financial system and solve all problems with that mechanism, and keep interest rates repressed. Never mind, other issues such as repricing risk or the systemic damage that those policies do. But if we're reaching the Keynesian endpoint here, we were reaching it before the COVID-19 outbreak. As you say, this started in September, where the repo market went out of sync with the Fed policy, and so. I think that's an important point to make here, that all of these trends that are they were already in place. In other words, the globalization was already kind of stagnating. It had entered diminishing returns. Like Apple's operating income had been basically stagnant for 4 years. I mean, a lot of these problems were already in place. It's just that this pandemic has acted as an accelerant, to existing trends. So we have to be careful to not sort of like blame the everything on the virus, but we have to understand that all these forces were at work before that. And so, as you say, but now it's a trigger for a bunch of policies. And I was particularly interested in your thoughts on Europe, because we all know that Europe is really at the core of a lot of these issues. Sure, there's China and the U.S. and globalization and tariffs and all this other stuff, but the European banking system and currencies, the dependence on the euro and a lot of the other issues that relate specifically to Europe. How do you think this is going to play out on those issues?
Yeah, exactly. And the fundamental problem with the euro in the European Monetary Union has always been the lack of a fiscal union, a lack of ECB, European Central Bank sovereign bond, which they don't have. So it's just bonds of specific countries. And they have extensive problems in the bond market there. There's banking issues. As you know, they've already gone through some level of financial crisis during 2008. And now it's just gotten exacerbated to a point where there's an emerging overall financial crisis coming out of Europe. A large part of the repo crisis is coming out of Europe. And so this opportunity of the COVID presents the potential to institute a number of initiatives and policies which would help the authorities in Europe to do what they need to do to save the euro, to save the European monetary unions. And specifically, that is to bring together fiscally all of the countries in terms of instituting a European central bank sovereign bond. So there's been talk recently about coronavirus bonds and so on, leading essentially to a sovereign bond at the Europe level. So that initiative is now in progress. There's also the issue of negative interest rates. So in Europe, a large part of the bond market has gone to negative interest rates. This has affected even deposits. A large number of people have been and are doing deposits at the negative interest rate. So why would you want to keep money in the bank if you can take the money out from the bank in terms of cash, put it in a safety deposit box, and not lose any money if it's in the safety deposit box? So there's definitely an interest to go cashless, to a cashless society, not only for the negative interest rate policy, but also it would allow no bank runs. So you wouldn't be able to run to a bank, ask for your cash. I mean, what are you going to do? Put it on a memory stick or a CD-ROM? I mean, that doesn't make sense. So that would take care of those risks. Then you have also capital controls, exchange controls that would also help to not have wealth drain or brain drain concerns. Less freedoms, liberties, the move to authoritarianism. So these are all initiatives that would help in keeping the euro, together in the whole European monetary union. Your thoughts?
Yeah, interesting that this move to authoritarianism. At one extreme, we can look at the People's Republic of China, where they already had their this tremendous authoritarian system of surveillance and social scoring and all that. And of course, this has provided the Chinese Communist Party with the perfect excuse to ramp up surveillance and start using infrared sensors to detect people with fevers and so on. But your list of all these restrictions that are coming online in the West goes to show that you can have authoritarian societies even in so-called democracies, because as you say, if these policies are instituted under the guise of being temporary measures due to the virus pandemic, but they actually remain permanent, then that's exactly what happened after 9/11 and after the 2008 global financial crisis, right? All these things about no longer mark to market and banning short sales and all sorts of things that were supposed to be temporary ended up permanent. I want to speak real quickly to there's a lot of stimulus, right? That's going to be the response globally, whether it's China, the US, or Europe. Everyone's rushing to create money out of thin air and feed it to corporations, the financial sector, and even small businesses and citizens, right? To kind of help support demand. But I think it would be interesting to talk about the limits on any kind of stimulus, whether it be fiscal or monetary. And to my mind, this is another argument for an L-shaped recovery, i.e., stagnation, and a kind of drawn-out recession that would be more like the 70s than the recessions that we've had recently. And just for those people who aren't old enough to remember, there was an extremely sharp and deep recession in 1973 and 74, which was triggered by the oil crisis of that time when oil basically quintupled overnight. But there were a lot of structural flaws in the system at that time. And so then these were sort of brought to light and exposed. And it took the entire decade to work out those things of post-industrial society and a lot of the excesses and inefficiencies. And so I think we might be at that kind of inflection point now, where the responses to the pandemic, whether they're relatively modest or whether they're an overreaction, in either case they're exposing, I think, the inefficiencies and malinvestment and super high debt levels and too much leverage and all these flaws in the system are now being exposed. And so we're going to have to work through all of that, and just printing money and giving it to corporations and individuals is not going to solve those problems.
Yeah, exactly. And I think the 1970s is a great analogy, because it was characterized by a lot of stagflation in terms of very low level of economic activity, declining level, but at the same time, rising levels of inflation, sort of the worst of all possible worlds.
Right. And just to make a quick elaboration on what these stimulus policies can't do is they can't create actual collateral, right? They're simply creating more claims on the existing collateral. They're not creating any creditworthy borrowers, which are the core of our, of the financial system in China as well as Europe and the U.S. I mean, all the investment and asset valuations, it's all based on somebody borrowing money who's creditworthy and able to service that debt. And if you don't have any creditworthy borrowers, or there are no borrowers who want to borrow more money who are creditworthy, then the system really kind of implodes, as it did in 2008. And lastly, just throwing money around does not increase productivity, which is the one source of actual wealth creation. So I'm very skeptical of any sort of stimulus, monetary or fiscal, doing anything other than acting as a Band-Aid. And I'm not against that in terms of, yes, bandage the wound, but do not think that's solving all the diseases, the financial illnesses and excesses that have built up since 2008. And we could even argue from 2000 or even 1982. So, by one set of parameters, we have 40 years of excess financial repression and financialization to unwind here.
Exactly. And the idea of inflation, in the sense of the Austrian School of Economics, defines it as a rise in the money supply versus the Keynesian way of looking at it in terms of a rise in prices, as a key difference between those economic schools of thought. I had a discussion earlier podcast today with John Charalambakis. He takes a similar approach that I do in terms of an Austrian School of Economics view. He pointed out that the money supply now is actually increasing quite rapidly as the stimulus goes more directly into the economy this time in this financial crisis, compared to the last one back in 2008, where it was more of a stimulus into the banks, which actually resulted in a rise in the monetary base, but not in the money supply, as banks held the money in excess reserves at the Federal Reserve. So the money didn't actually go into the economy, so the money supply was not increasing. We didn't see the massive inflation that everybody was expecting. But this time around, it is showing up in the money supply, at least for now. And so this is portending towards rising inflation, that stagflationary environment that we just mentioned.
Right, and I totally agree with you, Richard. And that we, in terms of the supply and demand shocks that are reverberating, starting with China's shutdown of its economy for a month, and of course that's driving some urgency, at least in essential industries, to be reshored, and that's so in terms of moving. Some of the supply chain to North America, for instance, that's going to incur costs too, because that's going to require capital costs and very likely higher costs going forward. And that's the trade-off of efficiency for resiliency, right? In other words, if you want a super long, fragile supply chain, that's basically optimized for perfection, and that's a fragile structure because there's no redundancy in it. There's no resilience, right? And so to increase the resiliency of our supply chains, that's going to add cost. There's no way to do that without any friction, So I'm mentioning that as to sort of support your view that stagflation is rearing its ugly head, because in addition to monetary based inflation, there's also just higher costs ahead as the supply chain gets rearranged. So
exactly, it's going to cost a lot more money to have somebody, within the U.S. and Ohio somewhere to make it relative to how much it costs to have it done in China. So that's going to translate to a rising inflation.
Right. And just as an anecdote in support of your comment about the nature of inflation being a part of the money supply, one of the books I'm reading right now is titled 1493, and it's about all the changes that the discovery and integration of the New World brought to Asia and the Old World, China and Europe. And one of the things that happened was the Spanish discovered enormous quantities of silver in South America, and this, of course, was money. And so it just was quickly distributed in China and Europe, and it created monetary inflation in both of those places, because it basically tripled the supply of money in a short period of time. And so the value of silver fell by 2/3. So even if you're using quote unquote real money, if you increase your monetary supply by an enormous amount, and it's way out of line with the actual increase in goods and services being created, you're going to get a debasement of the currency. And so that goes to show that you can even get debasement of the currency using precious metals if you flood your economies with new coinage. But so imagine here we are just printing worthless paper and thinking that it's going to hold its value. That there's just no history to support that.
Yeah, and it's all consistent rising inflation, loss of purchasing power, debasement of the currency, towards trying to make the level of debt, all of this Keynesian-based stimulus that has happened over the years, to try in an effort to try to make it more manageable. If you do the numbers, if you have 4% inflation over 10 years, it reduces the burden of debt by 1/2. And so that is the math. So the higher the level of inflation, the less the burden of debt. Of course, you're going to have loss of purchasing power, lower standard of living, things costing more and more. But those are the negative effects.
Right. And so then it's, I guess the question then is, Richard, if this is the Keynesian endpoint, then this whole gambit that you described, where they're going to try to create just enough inflation to make the debt manageable, but no more, that they're not going to, that, I don't know if that's possible. It could easily run away from them, which is what happened in the 70s. And if wages are going up by 1 or 2 or 3%, and inflation's running at 12% a year, pretty soon the average worker simply can't afford to live.
Exactly.
And that's, I think, a very real danger here going forward. I don't know if you agree or.
Oh, yeah, totally agree. And so what do we have as suggestions? Is there any way out? What are the positive things that could be done? I think it makes sense to go back to your recent book, Pathfinding Our Destiny, Preventing the Final Fall of Our Democratic Republic. In it, you outline suggestions for a decentralized economy, more local-based, and if you wanted to elaborate that as a positive way of getting out of this crisis.
Yeah, thank you, Richard. And thanks for mentioning my book. And I wrote a book also called Money and Work Unchained, which talks about how we may need to, make a new arrangement between labor, and the money, the wages that are paid. I think we could definitely say that the centralized model of continuing repression of civil liberties and financial repression is not going to be a winning strategy. I think it's going to lead to the collapse of the current status quo. And so to get away from that, we're going to need, number one, some kind of sound money. Now that could be just straight precious metals. It could be a crypto currency. It could be a currency that's backed by precious metals or other commodities. There's a lot of ideas out there, and I think there may be some experimentation necessary, or possibly we go to a world with multiple currencies. So there would be a sort of competition to retain purchasing power, as opposed to the financial repression model we have now, where the fiat currencies are basically shoved down our throats. We're not allowed to use anything else. And a decentralized economy has the benefits of being flexible, in terms of increasing productivity, and also being more sustainable in the local ecosystem. And so we have to think about that. I think, sort of to summarize, the current system simply isn't sustainable, and many of us sense that and understand why. And so to have a sustainable global economy, it needs to be relocalized, decentralized, have sound money, and have incentives built in to make better use of Earth's resources, rather than sort of squandering them for like short-term growth and profits. Those kind of incentives have not created a sustainable system. So those are the kind of ideas I have on moving to a sustainable economy, which would also be fairer, less prone to huge wealth inequality, and also I think more opportunity based. I think we can give normal, ordinary people more opportunities in a decentralized, sound money economy than we can in the one we have now.
Exactly, and this is all consistent as well with the principles and the values of the Austrian School of Economics, in terms of having a limited government with little or no influences by special interest group, lobbyists, an economic system that is based on sound money, that provides sustainable economic development, a system that is also characterized by little or no debt, little or no leverage, and just overall a limited government, smaller government, more efficient, that is decentralized, as you mentioned in your book, much more flexible to deal with economic development, and that fosters, because of that, overall entrepreneurialism and innovation.
Yeah, I think you've just summarized the economy of the future very well.
Well, great. How can our listeners learn more about your work, Charles?
Yeah, please visit me at of2minds.com. There's sample chapters of all my recent books, and all my archives are free.
Great. Thank you very much, Charles.
Thank you, Richard. It's been a great conversation.
The FRA Roundtable Insight Show is for informational and educational purposes only, and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors, which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.